Investors Chronicle.
Hello and welcome to the latest episode of the IC Interviews podcast. I'm Dave Baxter, I'm the funds editor on the IC, and today I'm joined by Charlotte Cuthbertson, one of the managers on the Migo Opportunities Investment Trust. Charlotte, thanks for coming on. How are you doing?
Thanks for having me. I'm good, thank you.
So as we perhaps euphemistically discussed earlier, it's kind of an interesting time both for markets and for investment trusts. So we're recording on 9th of August. We've seen plenty of volatility in markets, and trusts are still under lots of pressure for various reasons that we will get into. So given you guys tend to, focus on various different trusts, often quite esoteric names, it might be interesting first to look at kind of what sectors you're interested in, what you're getting into, but also, whether there's anything you're kind of avoiding or perhaps where you're not as convinced of the kind of buying case as some others might be.
Yeah, I mean, interesting is definitely the word for what's been going on in markets, certainly very recently. And for the investment trust market, the past 18 months, 2 years has been a very, very tricky period. So that has been for ourselves running Migo and our open-ended fund. That's been a great opportunity to build a really interesting portfolio of very, very discounted investment trusts. That there's nothing going wrong necessarily at the portfolio level, but investment trusts have been in a tricky situation for a while. If we look at how the portfolio's changed over, say, if we look at sort of the end of 2022, we had about a 15% cash position. Markets felt quite toppy. When fast forwarding to where we are now, we're actually about 6.5% geared, and this is the first time we've been geared since the COVID crash in 2020. So the opportunity set is just really exciting at the moment. In terms of what where has that money gone? It's our exposure to alternative income generating trusts has grown enormously. These were trusts that were launched while gilts were yielding next to nothing, and investors were looking for products that would provide them with a yield and provide their clients with a yield. So we're looking at sort of infrastructure, renewables, ship leasing, lots and lots of different trusts that were income producing vehicles. Once we saw interest rates rise and you could get income from more traditional sources such as treasuries and gilts, the demand for these products just fell sharply. So you had, and still continue to this day, have a lot of oversupply and just not the same demand as you had. And this is a whole raft of trusts within the sector that have therefore fallen onto large discounts. So we've put a lot of money to work in that area. So some renewable energy, some infrastructure, some ship leasing is about 3% of the portfolio at the moment. And then other areas that have been hurt quite badly with the sort of rising interest rates and the difficulties in the market have been areas like biotech and growth private equity. So those are two baskets that have also we've added to a lot over the past sort of year or so. So trusts such as Schiehallion, Chrysalis, Augmentum. And what happened here is that investors, if you've heard myself and Nick talk about the portfolio before and Migo and what we do, you'll have heard this phrase because we like to use it a lot. It's an arbitrage between perception and reality. It's looking for opportunities where investors are looking at an underlying portfolio and maybe missing what's actually going on underneath. And this was certainly the case with sort of this growth P basket, where investors got very, very nervous. These were the underlying portfolio companies were, cash hungry, miles away from profitability, and this would be increasingly harder in a higher interest rate environment for these companies to continue. But actually, if you lift the lid, and that's what we do, is our day-to-day job, is really lifting the lid and getting to grips with what's going on underneath. Actually, lots of these companies are much more mature than the market was necessarily giving them credit for, and these trusts were trading on 40, 50% discounts at their widest. So we built that basket. Again, with biotech, if you looked at the valuations, there was a lot of nervousness around the biotech companies. And again, an area that has the potential to be very cash hungry. But the biotech industry was trading, I think, last year was and beginning of this year was trading at valuations against the S&P that we hadn't seen before. So very, very undervalued. And what was actually going on in the biotech market, the fact that healthcare companies, we've got a patent cliff coming, and they need to be buying these biotech companies to continue having new drugs that they can replenish when their kind of blockbuster drugs come off patent. So that's another area that we've been adding to. And then in terms of things that we're shying away from, a bit nervous of, China springs to mind. We have lots of the Chinese trusts fell to discounts, but that's an area of the world that we feel is under pressure. We don't think the economy is obviously under pressure, and you've got that sort of geopolitical risk as well. We have very little sort of mainstream US. Again, it's just an area that looks, expensive, and we're looking for opportunities that are overlooked and unloved, and areas, like the kind of sort of US main market just don't really fit into the mandate, and there's just not a lot of value around. So we're looking for those opportunities that, where we think that investors are missing the underlying case, and we can buy it on a big discount.
So how do you deal with, you mentioned sort of geopolitical risk, but you do have some sort of single country funds, focused on Georgia, Vietnam, India, and so on. Like, how do you manage that?
Yeah, and it's something that we've looked at and are continuing to keep a very sharp eye on, because geopolitical risk is certainly increasing. What we have with both Vietnam and Georgia is we're looking for places where actually they are beneficiaries of some of the geopolitical risk, and Vietnam particularly springs to mind. It's actually a net beneficiary of the Chinese-US trade war. People, companies don't necessarily want all their manufacturing in China, moving a lot of it over to Vietnam, and Vietnam's done a great job sort of being able to have a foot in both camps, having a good relationship with the US and having a good relationship with China. And so we're looking for situations that are sort of benefiting from some of this geopolitical risk. That doesn't mean that we're complacent about it, because there is a lot of nervousness around what's going on. We saw that in Georgia with the introduction of the Foreign Agents Bill, a lot of volatility, especially for the investment trust. But it's something that we do think that the long-term story for Georgia still holds. We still really like the portfolio, and the trust is trading on a huge discount. And we think that actually we have a lot of confidence in the management and what they're invested in.
And turning back to, so you talk about reality versus perception, the very widespread, very large discounts across the sector, show there is a big gap between kind of perhaps what managers might think about portfolios and how much investors trust that, or the general sentiment. As such, you can almost throw a stone and hit an investment trust is on a huge discount. I was just looking at the PE sector, that's on average of 20%. There are some huge discounts there. There's a lot of choice, but like, what would you, I suppose this is a challenge facing a lot of our listeners, like what would you actually look for to decide that one trust, say in the PE sector, is more looking more solid than the other?
So I think an important part of what we're looking at, an important part of the investment process, is identifying a catalyst. As you say, discounts have never been this wide, and you can invest in lots of different trusts on wide discounts. The important part is to be looking for, why do you think that discount will narrow? What is the catalyst for you to extract that value? So if you're looking for, and increasingly with what's going on in the sector at the moment, realizations, mergers, acquisitions, if a trust, if you can see or believe that a trust is a probable candidate for a wind up or being taken out, that's something that we look quite closely at. there has to be a reason why, because there are lots of trusts that trade on big discounts and continue to do so. You're looking at, does the board understand and the managers understand the use of buybacks, the use of realization opportunities? Are they selling assets to return capital to shareholders? What is a trust in terms of the managers and the board? It's a combination of the two. What are they doing, and do they understand what needs to be done in order to combat that discount? So it's looking at for that catalyst and looking for trusts that will are doing something to help themselves.
Yeah, that makes sense. So yeah, you mentioned kind of M&A. One big, I suppose, issue in the sector relates to kind of scale. You've had wealth managers consolidating, especially Rathbones Investec was a huge one in recent times. And now it seems that the kind of bar for what people might dub a so-called subscale trust has risen even higher. Some people say £300 million or so on. How much do you kind of take that into account when you're kind of judging what you might hold?
Yeah, it's an interesting question. It's because, as you say, with the continued consolidation, it means, as you say, that the bar for what can go on a buy list, for example, or what people feel confident in terms of liquidity, sort of goes up and up and up, and therefore, some of the very big wealth managers, I mean, 300 million, I think, is quite small for what they would actually need in order to have the liquidity. So, you're looking at a billion plus. However, that doesn't mean, I think it's looking at whether trusts are just relying on, the sort of traditional owners, like the bigger wealth managers. There has been splintering away from some of these bigger managers into sort of, we've seen lots of smaller Raymond James offices popping up, and people who are running a bit less in these smaller wealth managers do have the ability to access trusts, as does the retail investor on their platform. So it's whether a trust is necessarily looking at just focusing on the traditional buyers, or whether they've appreciated that the world has moved on and there are other areas that there's other pockets of buyers that have popped up. So retail is a huge part of Migo's shareholder register, and it is for an awful lot of other trusts. So it's the consolidation is definitely a headwind, but I think we're seeing maybe a pivot towards other investors.
And is there, I mean, do you still see much of a case to kind of dabble in those smaller trusts? Like you made a very interesting comment to me before we were recording about, we were discussing all the kind of various market falls that have been endured in recent days, and you were saying in some cases shares aren't always actually liquid enough to get in. So I guess there's kind of there needs to be more of a measured approach if you want to hold something like that.
I think this is the great thing about running an investment trust, is that because we don't have to deal with inflows and outflows, it means that if we want to, either buy or sell something that's quite illiquid, we can chip in and out of it. So we don't necessarily have to be looking for a blog, or, a bigger wealth manager has to, if they get 10,000 shares, has to allocate it across all of their client portfolios. That's just not the case for us. And therefore, we have the opportunity to be investing in smaller trusts because we don't have the same liquidity issues that maybe other market participants do have. So we can find opportunities that are further down the market cap spectrum. I think also liquidity is a problem across the UK market, whether it's investment trusts or in the sort of even medium, small micro cap area. Liquidity has become poorer over the years, but I think there's more liquidity than maybe necessarily people are giving trusts credit for. So I do think that, but as I say, that is one of the huge benefits of running Migos the way we do, is that because we're closed ended, we can invest in stuff that is a bit more liquid that others necessarily might not be able to.
Yeah, that makes sense.
You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
So you were talking about there are lots of, I suppose, interesting opportunities in the alternative space, and obviously investment trusts are probably still the main gateway for investors to access those kind of things. Are there, say we're in slightly, I don't know, sunnier times when there's more kind of growth in the sector, you see issuance, you see IPOs once again and so on, which seems like a very odd concept at the minute. But are there kind of any areas of innovation you would like to see, any kind of asset classes that are interesting that could be opened up, or if you had if you could write a wish list, I suppose?
I think, yeah, if at the moment the idea of an IPO feels a long way off, but it's these things are cyclical, and we're at the part of the cycle where there's consolidation and oversupply, and and that won't last forever, and there will be opportunities, going forward where we'll see issuance and new IPOs. Off the top of my head, I mean, the investment trust world has got an extraordinary amount of different asset classes, whether it's space technology, ship leasing, you've got all the different kinds of renewables and infrastructure, different property sectors. So, I mean, there's, we've had song royalties, obviously that's been taken out, but, because investment trusts are, because of the way that the vehicles are, they are the only way for people to access incredibly illiquid asset classes, because you don't have to worry about daily liquidity. If there is an asset class that can be, a liquid asset class that can be, launched, it'll have to be an investment trust. So, I mean, I'm sure going forwards there'll be some more weird and wonderful asset classes being launched. In terms of wouldn't say necessarily I have a wish list, but we tend to be looking at this stuff when it's less popular. So we'll let it, this stuff IPO and then see what happens kind of a few years down the line. And that's, that tends to be more of our market rather than necessarily supporting IPOs. But, we don't think, there's obviously been some chat about, it's been a difficult time for investment trusts, but it's not a dying asset class. We're still very positive and optimistic about it. We think actually what's happening at the moment in terms of mergers, acquisitions, consolidation, wind-ups is very healthy for the market. There has just been an oversupply, and that will work its way through. So I imagine in 5 years, sitting here, we'll be talking about some other weird and wonderful asset class that's fallen out of favour that I couldn't have even imagined sitting here now.
Yeah, I was just trying to think up something myself. You mentioned music royalties and I guess generally talking about IPOs. I think back to it must have been 2021 when there was the real kind of explosion of issuance and IPOs and that kind of thing, and lots of choice. Alternatives were still very in vogue. But there have been some interesting lessons in recent years. For example, people were perhaps reminded that a lot of those alternative asset classes are quite correlated to things like bond yields and so on, and are actually almost, in a sense, quite long duration assets. So if you were considering kind of newer trusts or newer subsectors, kind of how cautious would you be? Do you need to wait through a whole kind of market cycle to see whether it's been tested? Music royalties, people started to become more relaxed about it, and then that got very hard hit in amidst all the kind of bond sell-off and so on.
Yeah, so I think, as we kind of talked about earlier, because we'd had such a long period of very, very low interest rates, it was 10 years plus from sort of the 2008 crash, all the way up until sort of the last couple of years. So and so it was right for those trusts to be launched, because they were producing opportunities for investors that were looking for yields. But once the world changes and that happens, it might happen more frequently going forward. We might are we necessarily going to see back to sort of 2019 interest rates? Unlikely, but that's not impossible going forwards. But so it's the world changes and suddenly markets are looking at something different. I mean, I think if we look at something like music royalties, it was also a situation where you had poor governance as well as an asset class that suddenly fell out of favour. So you had a combination of things in that situation. I think I've got to give a lot of credit to my colleagues at AVI for getting a good outcome on that one. But I think what we look for is situations where if you look at what the renewables at the moment, it's the demand for the structure that's suffering, not necessarily the demand for the assets.
Yes.
So it's looking at where do we see opportunities that the underlying assets actually have a very strong secondhand market value versus the fact that investors just don't need this kind of vehicle anymore. So it's not necessarily that there's anything wrong at an asset level. It's just that the market's changed, and that happens all the time. So, it's happened obviously more recently in a much bigger way than we've seen for about 10 years. But, going forwards, things might be a bit more up in the air. And you just have to react to what's going on at the time.
I can imagine it's slightly frustrating for investors seeing these, and you saw some of that with the Hypnosis songs developments, kind of seeing these interesting asset classes get sort of taken out on the cheap, or you see, all sorts of weird and wonderful things like a forestry investment trust got bought out and so on. But perhaps, as you say, I guess simply if markets are a bit healthier, maybe that's less of a problem. But yeah, you mentioned AVI's involvement with the Hypnosis continuation vote back and forth and so on. And it's interesting to note that kind of value and activist investors are still pretty rife in the sector at the minute. You've seen names like Saba Capital have kind of swooped in the last year or so. How does that kind of inform your thinking when you're considering a trust? I mean, do you generally see it as a kind of positive thing if one of those, maybe more leaning to the activist side than just the value side investors kind of sits on the shareholder register, or how do you assess it?
Yeah, so activism, we always say that it's a tool in the box. We've done a bit of it ourselves in the past, and we can certainly see there'll be situations in the future where that will be the case as well. Activism is important. We like it to be positive as much as possible, but it's always good for activists because you have a situation, therefore, where the boards are having their feet held to the fire a bit. And when you're trading on huge discounts, that's very important. It's very important for the people not to feel relaxed and just sort of waiting for, the market's hard and it's a tough market, investment trusts. You want to see boards looking at ways in which they can narrow that discount, close that gap, do something that will help. And activist investors tend to help focus the mind, shall we say, on doing that. Whether if you look at something like Scottish Mortgage, Elliott coming onto the register, and around the time when they announced a huge buyback, that's been very positive for that trust. And so, activism is something that is very important. And we do think that having active shareholders who have, good relationship with boards and a good dialogue with boards, that's very, very important. It only makes the investment trust world, better. So, but it's not. We don't see an activist come on a shareholder register and necessarily say, okay, well, we should join them. But it's something that we think is positive overall for the sector.
I suppose it's a long time since you had something like the Alliance Trust Elliott's battle of 2015 or whatever, which was quite ugly at the time. I remember.
Yeah. I mean, and these things, can get can get a bit ugly. But the way that we look at it when we're trying to, we try to do as much of it as possible behind closed doors. And when we're doing kind of activist work or getting involved in something, we try as much as possible to have that as a private dialogue where we can, just because we think that it tends to help with the outcomes.
And finally, I just wanted to touch on, another big trend we've seen in the UK markets and in the trust sector is, you mentioned earlier, really, but share buybacks. How do you kind of feel about? I suppose there's an interesting tension between things like buybacks and then how else you could use that capital. I think I remember Invesco Asia or some trust had the chair saying we don't want to do buybacks because we don't want to stand in the way of kind of the investment managers buying all these deliciously cheap stocks. Do you have a level at which you would kind of judge a buyback as more interesting and attractive than, say, investing or doing something like kind of boosting a dividend, that kind of thing?
Yeah, I mean, buybacks are, very important, and it's a tricky one because, as we've talked about the liquidity, trusts are under pressure to grow, not shrink. And so there are lots of trusts that are reticent maybe to do too much buying back because they don't want to shrink the amount of shares in the market and shrink the size of the fund, the trust, because then, you can see it as sort of making things worse. I think that that's not necessarily, it's a view, but we look at it as, if you look at it mathematically, when you're buying back, the return that you're getting from, taking, ratcheting up that NAV and taking out the shares versus what can you get from making new investments, usually the best capital allocation is buying back your own shares, especially if you're trading on a very, very wide discount. So, we'd see, but we can understand how managers feel frustrated because they can see in their own, remit and their own sector that they're, very experienced in lots of, opportunities, and they want to be making investments in the areas that they, know very well and can see amazing opportunities. But if you look at the return that you get from a share buyback, versus what you would necessarily get making new investments, usually the buyback is the way that we would want them to allocate that capital. However, you do have a situation where, if you have an 8% overhang and you buy back 6% of your share capital, you still got a 2% overhang. So there's no magic bullet, because if there was, everyone would do it and there'd be no discounts, and it would be a much simpler market. So there isn't a straightforward answer in terms of buybacks. I think in this kind of market, is upping your div necessarily going to attract people? I would say probably not. I would say a buyback would be probably more attractive, but we're not without sympathy for managers, but usually for what we say is that buybacks are considerably important at the moment. So yeah, in terms of capital allocation, that would be probably our view.
And how have you felt about the talking of allocations? Kind of a lot of the private equity trusts have been dipping a toe into kind of more shareholder pleasing measures, whether it's buybacks, but also creating these sort of ad hoc capital pools for doing things like dividends.
Yeah. So, anything where we like managers, thinking about what they can do to best serve shareholders. But I think that comes from, an in-depth and sustained dialogue with their shareholders. So if it's sort of an idea that, managers have had or a board's had, as a combination, it's the best thing for trust to do in these situations is talk to their shareholders and find out, what is it that is that would be most beneficial for them, whether it's doing a buyback and taking out an overhang, or whether it's whatever it is, selling off some companies and returning capital, finding out what it is that your shareholders want, because that's who you're serving. Your shareholders are your clients, and you need to be very, very thoughtful and very, very cognizant of what is most important to them, rather than necessarily having deciding for yourself, or I think this is what they'll want or this is what they'll need. The most important thing for people to do is to have that dialogue with their shareholders.
I suppose we'll see a big legacy of the last year or two where trusts have introduced kind of measures to try and ease shareholder nerves and so on. Well, yeah, very interesting stuff. I'm afraid that is all we have time for. But Charlotte, I'd just like to thank you for coming on. I'd like to say thanks to our amazing producer, Maddie Apthorpe, and thanks to you for listening. Take care.